1932. Protecting the future of working families, Teamsters1932.org.
You're listening to an encore presentation of this program, KCAA, the Inland Talk Express.
Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome, everybody. I'm Jeff Barton. This is the show. Yes, you've tuned in to listen to me on the radio, and I am Jeff Barton, the Mortgage Voice, and we come to each and every week on KCAA airwaves, as well as YouTube, Jeff Barton, the Mortgage Voice, a bunch of other podcasts. And certainly, if you want to see and hear us on a daily, go to YouTube, Jeff Barton, the Mortgage Voice. And as I said, we come to you to bring you information about mortgages, information about real estate, about what's happening in the state, of all those different kinds of things. KCAA brings our signal to you in the Inland Empire as you're driving around today, Saturday and Sunday, listening to me talk about these kind of things. Hopefully you stay with us because you might learn something and help you in your particular quest to either get a better mortgage than you already have or to get into a piece of real estate when you thought you might not be able to, financing-wise. There are a lot of different programs and things available out there in the marketplace, and we bring to you guests who talk about that as well as talk about the market conditions and some of the things that go on in the world that are going to affect you and how you think. I have a lot of experience in this business, and one of the things that is always been a challenge for me when talking to clients, customers about loans, about the products that are available to them, is that the noise you hear on a daily basis, whether it's on the radio, over the radio waves, you're driving around, a lot of people listen to the radio, or you listen to Sirius, or you're listening on television stations. They're all on as you're driving around. But this kind of information that you listen to, what kind of information is it? Who's giving it? And what is the point of the particular show? Now, I've always said this show is about educating people. Yes, I get people on and the guests, and they pitch themselves in the programs. But for the most part, it's an unbiased kind of look at things. I mean, I may get political in certain areas of what's happening out there, but not necessarily all the time. However, when I'm listening to shows about economic news, and there's a ton of it, you go to Bloomberg, CNBC, MSNBC, there's all kinds of news out there about what's going on in the economy. So you have to look at the source about where this news is coming from so that you know exactly what kind of slant you're listening to. I never thought it'd get there in the economic news, but of course it is. Of course it arrives, and it shouldn't, but it does. Now, let's just talk about things like inflation. We talk about inflation on this show, and I usually have a thing or two to say about it, where it came from, how it got there, and the looking forward to see if and when the inflation is going to get better. I've always said that my opinion, a lot of it had to do with corporate greed, a lot of it had to do with printing of money. But if you go to certain websites and certain TV and radio, you will hear a slant that doesn't encompass all of it. And I think you got to encompass all of it to get the right idea as to what's going on. Let's look at the housing market, for instance. We have a housing market right now which is really, it's been in the dump for a long time. And the reason is because we don't have enough houses. Now, why we don't have enough houses can be traced back a decade, maybe a decade and a half. Certainly to 2008, 2009. When those house builders, the big house builders, KB, Pulte, you name it, they're out there. They lost their shirt because they built too many houses during that housing boom, and therefore they said never again. So they went to the model of, we're going to build models and we're going to take orders and we're going to build to order. Not unlike what they do in China, not unlike what happened in China, happened here as well. The housing market went down. The economy almost tanked, had to pump in billions, and trillions of dollars into the economy just to keep it afloat. At that time, it was the banks. In China, I don't know what they're doing right now. But here in the U.S., we currently have not enough housing. That's why the housing market is in a dump. It's not about the mortgage interest rates, even though people will blame the mortgage interest rates. Because let's face it, if you can get into a house today and afford a monthly payment based on the ability to repay rule, you should do it without question, without worrying about the future, without worrying about what your job is going to be. The reason is because equity in your home is the number one way that you can build long-term wealth. It just is. Now, if you are in a situation where you're spending more and more and more on rent each and every month, and by the way, the inflation numbers that came out today proves me out on this. The core inflation numbers that came out today, first time below 4% since May of 21, right? However, the driver of the inflation numbers is rents. We don't have enough houses to have people live in. Therefore, the houses that are available out there are being rented. And those houses are continually going up in rental costs. Hey, if you're in Riverside or San Bernardino today, go and look at what listings were going for rents in the newspaper. I know, go old school. What they were a year ago versus what they are today. I'm telling you, they're probably up more than 10, 15%, which is very, very high. So that number, that inflationary number of rent accounts for 50% of the increase in the overall inflation of the market. So if we see today inflation is hot, and again, depending on the network you go to, depending on the station you listen to, depending on people like me who are speaking about it, they want to blame somebody. Again, we don't have enough houses out there. It's simple. The houses that are out there, if the landlord wants to jack the rent, they can, because there's nobody to compete with that particular rent, so you got to pay or you got to move. That's just kind of the way it is right now in this particular market. Now, I want to just bring it to your attention so that when you're saying, oh my gosh, the economy, I can't buy a house, I can't afford it, prices are going to go through the roof, mortgages are so high. All this is true, but the main culprit of it is not enough houses. And the answer to it is build more houses. Now, if you go to, I don't know, there's a lot of public data on it, but there are many, many areas in the country that are building a lot of houses, and that the houses aren't that cheap. I'm going to give you a list of them right now, really quickly. Let's see. Okay, these are 10 top cities in the U.S. where they're building a lot of houses, and they also happen to have pretty cheap houses. Now, you may say, where is that? But believe me, these are urban centers. These are not in the middle of nowhere, okay? All right, so let's just look at a couple right here. The 10th is a place called Myrtle Beach. Everybody knows where Myrtle Beach is. Where is Myrtle Beach? South Carolina?
Florida.
Oh, it's Florida. Okay, well, there's two Myrtle
No,
Beach.
I don't know.
Okay, so the median sales price of houses there is $341,000. And there are almost 12,000 permits being pulled, which means that this area will probably remain cheaper than anywhere else, and there's more houses. See what I mean? More houses, cheaper prices. That's the way it goes. Pulling permits is a reflection of what the future housing market's going to be in these areas, which are already cheap. Another place is Austin, Texas. Everyone's heard of that. Median price there is $452. Not cheap, but they're pulling 35,000 permits this year. So we know these new houses coming on the market will be reasonably priced because there's more of them being built there than other places which either can't get the permits going or don't want to because they like the high prices. Now, who's controlling this? Where's the mastermind behind all this? There isn't. It's greed. Let's face it. Inflation, the number one inflationary item that never gets talked about is your house price. If you own a house and you've owned it for the last 10 years, you've doubled the price of your house and have done nothing. So that particular inflationary pressure on the marketplace means that unless you got to have that money, you're not going anywhere with it. A couple other areas, and then we'll just move along. Sioux Falls is number 2 on the list. Great prices there. Sioux Falls at $243,000 and about 4,000 permits being pulled there. And Huntsville, Alabama is tops on the list. Number 1, $370,000 is the median price, and 5,700 new permits are being pulled there. I think all of these things this is what you got to keep your eye on. I know it's a little bit confusing because there's a lot of information that we throw at you on the show. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry, and we'll be right back to try to sort it out.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show for each and every day, listening to us on the weekends as you're driving around, you're going to the hardware store, you're going out to church, you're coming home from somewhere. Tune us in. As I said, KCAA brings us to you, and I'm really happy that they do that because the information you get here, unbiased and really straight from the horse's mouth. I've been in the lending business for 25 to 30 years, been in real estate since, I don't know, forever. So the information that we try to give you is, like I say, straight from the horse's mouth, unbiased. And one of the great things about being the host of the show for the last 10 years is that I get to meet and know a lot of great people in the industry. In the Inland Empire, George Gonzalez joins us again. He's from Rancho Cucamonga, and I believe you still work for Malibu Funding. Is that right, George?
Yes, sir.
Excellent. How are you?
I'm doing great. Thank you for asking, Jeff. You know, how are you doing over there?
Well, you know what? We're okay. I've just been following the market, and I get so incensed at, as I was saying earlier on the show, I watch a lot of the financial news shows, and so many of them are either totally opinionated or they're just pitching something. And rather than just try to get to what is happening, I just got to get into their stuff, and it always makes me cranky. So how am I doing? I'm doing great. I try to see what's best in the marketplace. What are you seeing out there in the IE?
Well, again, you hit it on the nose. So you said, everybody, they hype you up, and then when you want the real cheese, they don't give it to you. You got to pay for it.
Right.
And
that's right.
So, and again, I guess that's what comes with skill. We work so hard so many years to build up skills, that has to be worth a little bit,
Yep.
So, but regardless with that, with the market, how it's been, interest rates coming back down, I'm noticing people are starting to dip and dab a little bit more and give me a call and ask to see, let's get our pre-approval back going again because, it doesn't look like it's going to be a crash like everybody's been predicting. And so that's basically what I'm seeing over here, Jeff, is people are trying to get back on board, but it's been a pretty calm winter other than that.
Yeah, you know what? It's funny you say that about people talking about a crash, and it really is dependent, obviously, on the local people that you talk to, as well as what you hear and what station or what particular side of the aisle you might be wanting to listen to, whether it's good or whether it's bad. I was trying to say earlier in the show, if you can afford it, if you got the monthly, do it. The reason being is equity doesn't get built when it's an idea in your head. You got to build equity by owning.
And that's my biggest scream to all my buyers is, listen, you're paying $3,000, $3,500 a month in rent.
Right.
Yeah, the mortgage might go up to $5,000, but you can afford it. You have the money. However, it's a different ballgame. You're paying down. You're building your future. You're building your retirement. You're building, your everything you need to do in the future for you can be secure. Rent continues to go up no matter where you go. The more crowded we get. The more the rent is going up because the inventory is low. Yep. So landlords understand that, hey, we can have high prices because it's either going to be high rent or high mortgage. You choose. You got to pay one of them.
Well, that's exactly right. And you have companies like Arrive, which is, a lot of it's funded by Bill Gates, right? They go out there, this large corporation buys up a lot of neighborhood properties, and then they just rent them out. If the corporations think it's a good idea to own, maybe that's a good idea for you to own, too.
Exactly. They didn't get rich and build corporations, making wrong decisions.
No, that's absolutely right. The thing that irritates me, of course, is we just don't have enough houses, and I can't satisfy that by, some magic wand that, okay, I'll have 1,000 houses over here. What are you seeing by way of that, new houses or fixing up? What's the market like in the real estate world out there?
Inventory wise,
Okay.
My area in the Rancho Cucamonga is in the Inland Empire. Is a little harder to get because it's a desired area
Right.
where people want to live. But just I want to say east, one city over, Fontana has been a pretty hot ticket, and a lot of inventories there of coming available now.
Okay.
I've been seeing it because what was happening, Jeff, is the last few months was the rates were high. Some of these sellers, or most of the sellers, were considering, well, if we sell, we also have to purchase.
Right.
And, if we purchase, then we're going to have to pay the high rate. So it kind of put a lot of people on hold on selling as well as buying.
I agree.
And so right now, as they see that, okay, now that the market's kind of peaked out in their eyes, in most people's eyes, the interest rate is peaked and it's starting to bounce down a little. Like I said, they're starting to get back on board, but let's just see, how long it lasts, because the last time this happened, within a matter of days, the rate shot up and then killed all the action that was starting to get going,
That's volatility, right? So what do you see in volatility in the mortgage market? And again, the difference between obviously 6.5% and 7%, or 6% to 6.5% is a lot. I mean, obviously you're going to have to pay hundreds more on your mortgage per monthly. But for most people, yes, it'll be tighter, but it's still a better idea to get in. I do not see rates going higher than 7%, but how low can they go? I don't know. Some people have predicted high fives, maybe mid fives by the end of the year.
Well, again, and then we're, as far as conventional goes, we're already in the low sixes, the middle sixes.
Okay.
So we're not too far away,
right.
And FHA is already in the mid fives, 5.625, 5.75 range. So we're right where we were back in 2008 and 9,
right.
when everybody was lovely buying. The only difference is the property, the value of the properties are now double than they were back then. So the payment obviously is double or triple than what it would have been back then. So I try to encourage my buyers that, listen, in 5, 6, 10 years, you don't want to say, oh, it increased another,
right.
3 or 4 times,
right.
and I missed out on the boat again.
I know. It's so funny. I'm driving around my neighborhood looking at things that I shoulda, coulda, woulda, right? Mm-hmm. I've done that so often lately, thinking, I could have had that for this price, and oh my gosh, look what the price is today. And I mean, it's amazing.
And the thing about it is, if you have, like I tell these people, they have the money in the bank for the down payment. They make plenty of money on a secured income that they've been for years. What is the problem? Just because everybody's saying no because they don't make as much as you, or they don't have the down payment like you, of course they're not going to say they want to do it.
Right. Right.
It's just a matter of perspective, Jeff, like anything else.
Programs. What are some of the programs right now that you see in the marketplace that are popular? Is it still the 30-year fixed? Are we going to non-QM more? Where are we?
Well, honestly, the for purchases right now, they're just regular conventional. The 20% down is what most people have saved up in the last few years, which is a good thing.
Yep, it is.
Well, they do have the down payment. But as far as the refis go, I'm just looking at a lot of home equity lines is what have been starting to call me lately. Is a lot of home equity lines to try to, get rid of their credit card debt.
Yeah, that's right. I mean, I did see that the credit card debt over December really shot up to be, just astronomical. Like, I want to say $1 trillion, some crazy number like that, outstanding credit card debt.
Right.
So you're seeing people wanting to pay that off, obviously affecting either their credit score or the bottom line, what they have to pay in a monthly. Right.
It's the, either it can be the credit debt, it can be student loans, it could be tax problems, it can be, divorce. A lot of that's happening as well. A lot of my agents are, working with clients who are separating and they need to sell and one needs to buy. So there's a lot of action going on, Jeff, but really it's just like on a threshold, ready to just explode. It's just a matter of time,
Okay, so we're in January. Where do you see us by March?
I see, by March, that's buying season. More people are getting prepared as long as the rates don't shoot up, a whole point or a point and a half like before. I think the purchase market should be pretty active. Well,
I think a lot of reasons that the rate went up so fast was because of the inflation. People were just afraid that everything was going to cost more, and as a result, it did.
Right.
And
it did. It did. People were buying a house today, and then next month selling it for 50, 60 more thousand in a month, or 100,000 more. Like, that's how bad it was at one time, as you know.
Yes, I do.
Years ago.
So, okay. Hey, listen, we're up against it. Appreciate you coming on. You want to tell people how they can get in touch with you?
Yeah, you can reach me directly at 909-900-9565. That's my direct cell phone number, 909-900-9565. Always available.
George, thanks very much for coming on again. Really appreciate it. Always enjoy the conversation.
Anytime, Jeff. Thank you.
Thank you very much. That's George Gonzalez from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, for listening to us as I babbled on today a little bit during my own section. Reason is that I'm confused, and I'm confused about things that happen in the world and why they happen that way. And the simple fix is straightforward and easy to see, but we never seem to get there. Case in point, why don't we have enough houses for people to buy? That just seems ridiculous. And if you have a house, are you the happiest person on earth? You must be, because your house just doubled over the last 6 or 7 years in value. For those that are out there trying to get into that space, we bring experts to the show to tell you how to do it and not to worry so much about the rate, but worry about getting in and getting started on building the equity in your home. Charles Giscombe from United Security Financial joins us now to talk a little about that and how we can help people do exactly that. Charles, how are you?
Great, Jeff. Thanks for having me again.
Thank you very much. Okay, I wanted to call you Swish because every time you get the ball, it's 2, or 3. That's great.
I like to think I can put that thing up, but getting old now, Jeff.
Well, okay, I hear you. Yeah, I know what you mean. It's so funny. Even the difference of from 3 years ago to today, I notice a difference. And boy, it's astounding. I'm like, wow, that age thing really does mean. It means more than I thought it used to. That's for sure.
Indeed.
Okay, so let's talk about young people, and because they're the ones that get out there and build their equity into a home. What are we talking about in terms of loans? What's the popularity of loans? Are we still looking at purchases in the 30-year, 20% down range, or is it more going towards the non-QM space?
You know what, Jeff? Right now, obviously, traditional rates in general, going down a little bit. But it just seems like the new age is looking for the path of least resistance, and that's going to be with the non-QM loan product. Those non-qualified mortgage products provide alternative documentation loan guidelines and requirements. And so now a full doc loan in the non-QM world, it simply might only be 12 or 24-month bank statements. It might not require any tax returns, W-2s, or paycheck stubs. Simply the amount of money you deposit in your business or personal account on a regular basis, and they take the average of those 12 or 24 months, and now that is now your income. That allows individuals to have higher income on paper, and the DTI is lowered because of the deposits that are made monthly. That average allows individuals to get out there and purchase. And they also can purchase loans with no loan limits, less loan limits, and no mortgage insurance. And non-QM also offers different terms that kind of offset the interest rate situations.
Okay.
For example, if the interest rates are higher, now you turn it into a 40-year amortization loan, and now you got an extra 120 months to make your payment, which obviously is going to allow that payment to be lower. You couple that with no mortgage insurance, Jeff, and even if an interest rate is higher, you're looking at a monthly payment that might be comparable to the low interest rates, at least closer to them that we had in the past, less a year ago. So now those are opportunities and options, as well as like CPA letters and profit and loss statements. Individuals who are entrepreneurs that are working for themselves have the ability to get into these loans confidently, and you can go anywhere from 90% LTV, meaning only 10% down, for a loan with that less amount of requirement, that's a pretty decent loan for a person to get into and still take advantage of what's going on as far as appreciation and equity. But like Jeff said, the shortage of houses causes it to be competition nonetheless. But at least those programs allow people to be on level playing field so that they can go get out there and be competitive for the properties that are available.
You know, in the non-QM world, and it's a question I've never asked you, but I've always wondered, there are different products, and you mentioned a number of them, obviously, to get people into a home in a different scenario than the 30-year fixed rate, kind of 20% down scenario. Within the non-QM world, because you have the different programs, and I assume credit still matters, if you've got the best credit and you have a certain particular loan product that you want in the non-QM world, does the pricing change on that depending on your program, or is the non-QM just sort of a blanket? Okay, usually you're going to pay 2% more, or are there differences?
No, there are absolutely differences. Great question. There are differences. Having a higher FICO score is rewarded. Membership has its privileges. Higher FICO scores.
I have one of those cards.
Absolutely. Membership has its privileges. Higher FICO scores. There also are platinum and platinum plus and gold and silver in the non-QM realm. You can get into the non-QM with a lower FICO score than most, but you still take advantage and open up the upper tier pricing when you have a FICO score that's a 720 or above. Same as conventional loans and FHA loans, but non-QM, obviously, the path of least resistance, but they do offer a perk for individuals that have higher FICO scores, for sure.
I saw a 7% today for jumbo, which I thought was pretty good on just a standard loan. What are we talking about in the non-QM world if we're talking about jumbo loans? And what constitutes a jumbo? Because I know what conforming jumbos are, non-conforming jumbos are in your Fannie Mae, Freddie Mac world, but what is it in? Is it up to 2 million? Is it up to million? 3 million? What are we talking about in terms of loan limits themselves on jumbos and the rates?
That is a great question that Jeff asked, and people really need to listen. If you're into the jumbo market, this is a great question. Please listen. In the non-QM world, I have a loan that can go up to $4 million. Okay? $4 million. There's no change in that product if your FICO score meets the requirements and you have the 12-month bank statements. That means you can get a 90% loan up to $3 or $4 million with no mortgage insurance, which means now it's not considered jumbo. You don't have to reach a county limit. You can go look wherever it is that you're looking to buy a house. That jumbo product for non-QM is jumbo across the board. There's not a limit for a particular county, state.
Right.
It's just jumbo, and they'll go there at high. And that loan can be from anywhere from $200,000 up to $3 million. It's going to be the same at 90% LTV. And an interest rate you can look at right now at one point in time was a 9 or 9.875 when the rates were high at 8. But you can get as low as a 7.875.
See, that's good. That's what I mean. Right.
On the non-QM loan right now today, if your FICO score is in the Platinum Plus tier at 90% LTV. Great competitive programming comparable to Fannie, Freddie,
exactly.
and Ginnie.
That's my point.
Absolutely.
I mean, and the restrictions on a Fannie Freddie loan versus this is worth the 0.75 of a point more that you're going to pay, because it's less, it's easier to get into the loan, and you can borrow more. So
and no MI. Once again, I have to always take that into consideration. And these loans all come with no prepayment penalty. So if the interest rates do get better, you can refinance immediately with no penalty.
That's awesome. I mean, I love that kind of loan product, because the jumbo market in the traditional models for Fannie and Freddie just been getting hammered with rate. They were like a point and a half, because nobody wanted to do the jumbos because they get beat silly with that 3% jumbo rate that nobody wanted to buy anymore on the secondary market. So you're stuck with those on your book. You didn't have the funds to do jumbo anymore. But in the non-QM world, what happens to these loans? What happened? Is it large hedge funds? Is it sovereign funds? What happens to them?
Yeah, you have a specific investor that is in their niche, hedge funds, private equity. What happens is they're comfortable in the non-QM world because they've been versed on the different qualifying factors.
Right.
If there's a comfort level with that and they're able to buy that, they will take that paper. It is a wonderful thing. And you also have to remember, a lot of times jumbo in the traditional sense comes with a much larger down payment.
That's right.
These loans,
90%, you said.
15%, that's
Yeah.
amazing.
Yeah, it's
to be able
amazing.
to get into that loan at that size. But yes, different investors, and they're becoming more comfortable as time goes on, allowing more types of loans and different kind of wrinkles and value-added services for it to entice individuals to get into the non-QM world.
Okay, we got about 40, 45 seconds left on credit scores. Have we seen models change? Or are we still using the same FICO system we've been using forever?
It's been the same FICO system. Usually when we're qualifying, we use Zactus. Obviously, now we use Zactus. What happens is that FICO model, we take the middle score of the three. Whatever the middle score is, that's the score that's going to get you to the qualifying. And these days, if you have an experienced loan officer that can work with a AAA credit company, then there's simulators, rapid rescores, and different things you can do. So don't be deterred by a low FICO score. You can get in there, get simulators done, and it will tell you exactly what the blueprint and the plan is to get your score to the required score so that you can qualify for all these loans that we discussed today.
Excellent. Charles, we've run out of it. Of course, I always hate to end it because we have a good call. But next time, onward and upward. Thanks very much for coming on the show. You want to let people know how they can get in touch with you?
Absolutely.
Thanks.
Jeff, you can reach me at 702-328-5191. That's that good old Nevada 702-328-5191. Or you can reach me at cgiscombe@usfwholesale.net. That is cgiscombe@usfwholesale.net.
Excellent, man. Thank you very much. I hope you saw that Timberwolves-Celtics game last night, huh?
Oh, you know what? I didn't see the game. What was the
Awesome.
outcome?
Overtime, Celtics victory. 18-0 at home. Come on.
Jeff doesn't care. It doesn't matter if it's 15 overtimes. Celtics on top. It's a great game.
Awesome. Thanks for coming on, Chuck. I really appreciate it.
Thanks, Jeff, for having me. As
Right.
always.
Bye.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Did you guys have a ceremony for Charles Munger when he passed away?
I mean, we didn't, but that was definitely big news all over the company.
Oh, yeah.
How crazy is that, right?
Big news. Well, I had him. I basically followed him for years.
Yeah.
You know,
Yeah.
he's just. I didn't follow the other guy. I followed him. And it's just funny. Yeah. All right.
Unbelievable.
Unbelievable. Okay. Yeah. All right. We'll start. Just let me know, Daryl. Give me 10 seconds.
No problem.
Bless you. Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us each and every week as we bring to the absolute best in both knowledge, but talent, really. Talent in our business means great guests. Guests that come on the show, explain what's going on, but also have the experience to be able to say, hey, you know what, this is wrong, this is right, this is where you should be going. A lot of times in our business, people come to us not only for best product, but they come to us for advice, especially in the real estate world. And joining us now is Meredith Schlosser, who has been on the show several times before. She works for Berkshire Hathaway out on the west side of California, and she joins us now to talk a little bit about what's going on in her business and how she actually advises her clients. Meredith, how are you?
Hi, Jeff. Thank you so much for having me. You nailed my last name.
Oh, man, I bet that one's a tough one for other people. I've only known you, 10 years maybe?
Yeah, at least. I think longer.
Yeah, I think longer, too. It's so funny, that property that I sold to my clients, your listing, boy, that was a long time ago now.
God, I think that was like 2013.
It was, honestly. Yeah, right, over 10 years ago.
Yeah, over 10 years, yeah.
Interesting. So in that part of the world, as well as the part of the world that you do a lot of your business, which is all over Los Angeles and some parts east of that, what do you see is the major push towards price increases? Is it lack of property, or is it that, I guess that would be the only thing that would cause the price to go up? Is that really why?
Yeah, I mean, the inventory, right, we're at an all-time low. We continue to be. I mean, there's what we are seeing in the last 2 months, especially here recently, with the rates coming down significantly into the low to mid sixes,
Right.
is there's more sellers willing to get off, the sidelines right now, right? They're
Right.
not feeling as much pressure if they're going to another property that potentially is more expensive. But that's really, what we're pushing for now is that people, when the rates were in the mid eights, where do I go? Where do I go? I'm locked into a 2 or 3% mortgage rate. It's a different conversation now, luckily.
So the pressure on mortgages easing a bit. Do you see that long term? What does the company say when you're talking about that company wide?
I mean, company-wide, I think, and even talking to other lenders and other, analysts within Berkshire, I mean, we
Right.
Predict that 2024 will see at least 3 rate cuts, hopefully over the next 6 to 9 to 12 months.
Right.
So I think consumers are feeling positive about that. I mean, look what's going on with the stock market, right? So I think there's positive vibes, if I can say that, all over the place right now, and buyers are feeling more optimistic.
So you're a young person, you're in your 30s, let's say, and you're wanting to buy a house. You've got some 401k money, you've got some investment in the stock market. You think the investment in housing long-term is a better investment than the stock market? Or do you think that someone should wait until they build up more money for a bigger down payment?
I mean, personally, I'm that age bracket. Actually, I'll be 40, which is in 6 months here. But
don't believe it.
I personally believe in real estate. I
Right.
mean, I'm true to what I see. I mean, yes, the stock market's great, but I mean, look at where we are, especially if you're buying in Los Angeles.
Right.
Saving money for the down payment. It's like, if you can afford. I mean, we have lenders, as people are doing as little as 5% down.
Right.
So I think it just depends on where people are emotionally and financially in their lives, right? As to what they want the next step to be. Something interesting that I wanted to touch with you on is, investors buying outside of California
Right.
and other areas that we're advising, and we're doing a number of deals. And I don't know if you want me to touch on that at all.
Sure, go ahead. Absolutely. I think anything that would help a consumer who's listening right now would be great.
Great. So we are, obviously being a landlord in California, we know it's tough, and there's more things coming on the bandwagon now that are going to make it even a little bit harder. But as far as investments go, we have a lot of clients right now that are looking to 1031. So we deal with a lot of properties and a lot of agents in Nashville.
Yep.
So right now, if you buy, and this is coming from all of our colleagues in Nashville and even myself, partnering up with other investors, if you buy right now in Nashville, we are anticipating, and other agents there as well, an appreciation of 30% over the next 3 years.
Wow. 10% a year? Wow.
Yeah.
Wow.
Currently, you're looking at a 6% cap rate.
Okay.
Another market that we're doing a lot of business and referring a lot to is Phoenix. You're looking at an average of 4.63% cap rate. So
Yeah, that's funny because Phoenix traditionally has been that place, but for the last few years, it's not really had that same reputation just because either it's overbuilt or there's some negative impressions about Phoenix area in general. Nashville, another area, great area. It's had explosive growth over the last 5 to 6 years, certainly.
Right.
I love Nashville. That's a great place to go.
It's a great place to go. So I think Austin is, Austin's been a little bit oversaturated. The prices have climbed, but it's just interesting talking to people in California if they can't or North Carolina.
Yep.
If they can't afford something here, because as we know, California is so expensive, just other areas that we can, advise them on.
Earlier in the show, I did, 4 or 5 different cities around the country where there are pulling permits, the major cities in the country, not the major cities, but secondary cities pulling permits, who they are, where they are. Austin was one of them. They pulled 35,000 permits so far for this year, which is a huge number. Obviously, they're new houses, but it's... if there's supply is there, obviously the prices aren't going to go up the way they would if there was no inventory and no permits. So I thought Austin was a great place to look at.
Yeah, that is true. No, I didn't know that. Thank you for sharing that.
Yeah, no problem at all. Do you like working for Berkshire Hathaway in terms of the reach that they have and also the financial details that they can provide you with information-wise?
I do. I love it. You know, when I left my previous company, I interviewed everywhere, and I've done a number of interviews, and people say, well, why Berkshire Hathaway? It's such a large company. Do you get the service you need? And I do. I mean, I'm in direct contact with our CEO, so it's
Wow.
pretty unbelievable.
Yep.
Of Berkshire Hathaway Home Services California Properties, which is a tongue twister in itself. So that's that as my last name. But it feels, and people laugh at me when I say this, but it kind of feels like a mom and pop brokerage when I go in there, because we don't have a saturation of agents. I'm out of the Brentwood office. I have my own office down Playa Vista.
Nice.
But we don't have hundreds of agents going in and out. The agents we have are top producing agents in the entire United States. So it's really nice to be around heavy hitters that I can get advice from. We can share, we can co-list, whatever we're doing, and getting advice. I mean, we know we're in a tough market, and agents, you and I both know this. We've been doing this for a long time.
Mm-hmm.
There's agents fleeing out of this business left and right.
Yep.
But at the same time, everybody wants to get in because they think it's quick, easy money because they watch these shows.
Right. Oh, that's so funny that you say that. And I was just about to ask you, you've always been a leader and somebody I looked at and admired in terms of the way you present yourself, both in print, but in media and other areas that you have a presence in a way by which you can sell yourself. Do you see that changing at all? New medias, TikTok, AI, anything out there that you're taking advantage of that we might want to look for you on?
I mean, I'm not on TikTok. I know I should be.
I'm not either.
I know. I think I should be. I don't really love social media, and I know it's a new wave, and we do have pages on Instagram. We're on Merit the Real Estate if anybody wants to follow us. But we do consistent email blasts. I mean, my core business is, thank God, and I don't want to be cheesy, but I don't want to say knock on wood because that's so typical, but it's really referral, repeat, and word of mouth.
Well, most experienced agents are like that, right? They don't rely upon that kind of presence. Although, if someone wants to blow up and do, 600-700 deals a year, and you see these super agents, and of course, they might talk to the client for 30 seconds. Nobody's doing 600 loans or 600 transactions a year. But referrals, personal, knowing them, meeting them in face to face, I think is still the best way to present yourself in the business. And that business is about trust. Real estate is about, can you trust the person you're doing business with?
That's absolutely right. I mean, we all know there's a lot of shady things that go on.
Yep.
And the responsiveness, right? I think that someone said to me the other day, what do you think makes you successful? What isn't? And I think, and I said, I try to have quality family time, right? Of course, I have boundaries, but I think it's the responsiveness when a client needs you without being, without getting, too into the weeds of always being available, but the responsiveness, and then the responsiveness with the other agents, right? Like when you and I did that deal, if you need something, if your client has a question, they don't want to wait a whole day to get the answer. How are you going to handle them? And I think everybody's personality is different, and I continue to see that 12 years into the business.
Oh, man, great answer, and a great way to end the segment. I'm sorry we're out of time. It's 10 minutes. It goes by fast. Want to have you back again because you're my go-to here in L.A. for real estate information and advice. Appreciate you coming on the show once again.
Thank you so much, Jeff. I appreciate you having me.
Thanks, Meredith.
Thank you so much.
Thank you very much. That's Meredith Schlosser. She's from Berkshire Hathaway. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us each and every week as we come to you via radio, via YouTube, via podcasts, a whole bunch of other places and things that we talk about on the show come to you from all these aspects. I mean, what we like to do is to bring to you different medium and different ways. The reason I'm talking about it and a little confused is simply because there is a plethora of stuff out there. I don't know if anybody's been watching, but this AI, which is in the marketplace, is affecting a lot of different industries. There's been many new videos out all over the place, from TikTok to YouTube to X to, I don't know, where else you might see your videos. But half of them aren't true because they've either positioned or they've moved places and faces around. It's so again, if you're out there right now and you're listening and watching all these videos and looking at a particular viewpoint and you want it backed up, just make sure that you check, and you can check to whether it's AI driven or where the actual source for that particular video is. Some of the websites have that information for you. Certainly YouTube does. I don't know if X does. X has turned into such it's unbelievable. Have you been on X? Do you go?
No, not at all.
Okay, so
No, not in the least.
I follow a lot of people on X, but it's just turned into this political melee out there. And unless you've got like the stomach to wade through it all, it's just very, very difficult. Okay, let's get to some news to use before I get to the next thing I want to talk about. Okay, 30-year fixed rate loan is 6.76%, went up a little bit. It was 6.5%. It's up a quarter point over the last 2 weeks. 6.02% is the 15-year, which is pretty good. You could probably get that 15-year in the high fives, which I think is a smoking loan. Let's see. FHA is 6.12. The jumbo is at 7.00, which has really come down about 1.5 points from its highs about 2.5, 3 months ago. I think that jumbo is also a good loan. 6.24 for the 5/1 ARM. The 10-year is at 4.032, and the 2-year is at 4.32. So that means 30 basis points between the spread, or is the spread of the 2 to the 10. It hasn't been really that close for, 2 years. We've been talking about that dreaded inversion from the 2 to the 10. Watching CNBC today, they talked about how that inversion is getting flipped back around. Stop and gone are the days where they talked about automatic recession if there was an inversion. The reason being is that it looks like we have what they call that comfortable landing. I don't want to call it a soft landing because I want to make up my own words, but that's essentially what it is. It means that your economic outlook and the way you are going to approach this year means I don't have to worry about losing my job. I'm going to probably make more this year than spend more this year in terms of the split between whatever inflation says and whatever I'm making, meaning that last year we had about a 4% increase across the board for wages and earnings, and I think 3.9% was the CPI today. The CPI is the consumer thank you. The Consumer Price Index. So all of that is good news, welcome news. It means you're going to be making more than you're going to be spending, and that's the type of thing whereby it reflects long term. Let's see. Okay, price rises. We talked about housing. We talked about the unavailability of housing in certain areas. Now, conversely, there are a number of articles out there recently, anywhere from Housing Wire to Mortgage News Daily, all the way to MSN. Looked at a lot of articles today. About a third of them talked about areas of the country where prices went down. Now, we talked earlier in the show, different segment, about the number of permits being pulled in certain areas around the country, meaning that prices in those areas, for new homes especially, will probably remain or go lower because of the abundance of houses in those areas. Usually if you build, you're building infill, which means that, there's a lot, you build a house, you sell it one at a time, because that's the only way that any kind of non-huge developer can really make any money. But if you are in the market for looking for where in the country the prices are lower and where they're higher, that's what these articles are talking about, where they're lower. Okay, let's talk first about where they're declining. They're not declining a lot, but they're not going up either. So if we're looking at average price this year going up in properties 4 to 5%, in these areas, at least they're staying steady or going down. States, we'll just go by the states. In Idaho, prices down 1.3%. Now, Boise saw a huge rise in prices when there was all that flight from the city, all the suburbs around Boise, but that has reversed itself, and now we see a reduction in prices of 1.3%. Utah, another state, prices gone down 0.4%. You see these are pretty minor, but hey, any reduction is better than an increase, right? And of course, Washington D.C. area, we've seen prices go down about 0.2%. On the flip side, prices rising. Rhode Island, 11.6%. Now, I love Rhode Island. You ever been to Rhode Island, Daryl?
I've been through by and stopped a couple of times.
Okay, I've got a family down there.
Providence is beautiful.
Providence is great. Warwick is great. If you go to the beaches, Newport Beach is great. What's another beach there? Jamestown's a beach. Anyway, I spent a summer or two there back when I was a kid. Loved it. My sister moved there, raised her family there. It's a great place to live. It's just hard to get to. I mean, you have to fly into Providence and drive everywhere, also drive down from Boston. Okay, sorry for that quick plug for Rhode Island. Connecticut, prices up 10.6%. Yes, bedroom community of the tri-state area from New York. It's always been a very heavily priced area, and to see it go up that much this year, wow, that's a big number. New Jersey, another place, again, the tri-state area. New York, you know what? It got hammered during the COVID pandemic, but it's really come back strong. And a lot of New York real estate is extremely expensive. There were, what was it? I want to say like $3,500 to $4,500 for a one-bedroom. I mean, it's just insane. Think about that. You're getting a one-bedroom space, which you have to share. Obviously, nobody who's living there, young people, are going to be able to afford that. Anybody who can't afford it, they're going to move to the suburbs and buy a house. I mean, it's just silly to pay those kind of rents. I have two of my children in New York City, so I know exactly what they're going through. But they're working. They're paying for it, and they're really paying for it, because you can't save anything if you're making, a certain amount of money, and 75% of that goes towards rent. But that's the way it is in that particular area. Anyway, New Jersey is up 10.5%. Okay, so let's see. Okay, if we're in a bit of an election season, right? Everybody knows that. And as I said, when we're looking at different news outlets or hearing different radio stations, trying to figure out exactly what is going on, and not have that particular viewpoint color how we look at housing. As I said earlier in the show, if you see something and you can afford it, buy it. Don't worry about the price. Don't worry about the mortgage. If you can make the monthly payment and the down payment. The reason I say that is because mortgage rates are going to fluctuate, but guaranteed, even if we have a housing downturn somewhat, we are one day, and not in the too distant future, going to see terrific equity in those properties that you buy today. It's just the way it is. Unless they're going to build 1.5 million houses a year for the next 10 years, which I'm not sure they are, we are always going to be behind the 8 ball in housing. Housing is one of those things whereby building enough sometimes isn't enough. Now, we've got long-term projections for population in the U.S. We do see it declining in terms of the rate of increase, but we do not see it like some other countries around the world, in Europe, Japan, Russia, for instance, where we see the population decreasing. One of the main reasons for it here in the U.S. is immigration. Now, whether you like it or you don't like it, having population increases really increases the chances that your Social Security will be paid, especially if you're in your 40s and 50s, because guess what? You're not going to be paying your Social Security. It's going to be the new employees that come into the country or are born here. But like a lot of Western countries, the actual population growth has stalled, and so importing people from other parts of the world are the way that those particular taxes will be paid. I know it's a political statement, sorry about that, but I just wanted to point out that yes, housing will be in great demand over the next 10 years easily, and as I said, we're behind at least 1.5 million extra houses per year for the next 10 years just to catch up. Anyway, I'm Jeff Barton, your voice in the mortgage industry. There's so much to talk about. We'll get to it next time. Thanks for tuning in.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
Listen to KCAA Loma Linda for less confrontation and more information.
It's that time of year again. No, not the holidays. Medicare open enrollment. And if you have questions about Medicare, you should talk to the local experts, Paul Berich and Associates. Paul and his agents are certified with plans that are accepted by most of the medical groups in our area. Call 909-793-0385. Their service is free, and after 42 years in the business, their agents are trained to help you pick the plan that's right for you.
Tahibo Tea Club's original Pure Pau D'Argo Super Tea helps build red corpuscles in the blood, which carry oxygen to our organs and cells. Our organs and cells need oxygen to regenerate themselves. The immune system needs oxygen to develop, and cancer dies in oxygen. So the tea is great for healthy people because it helps build the immune system. And it can truly be miraculous for someone fighting a potentially life-threatening disease due to an infection, diabetes, or cancer. The tea is also organic and naturally caffeine-free. A 1-pound package of tea is $49.99. $19.95, which includes shipping. To order, please visit TeheeboTeaClub.com. Tehebo is spelled T like Tom, A-H-E-E, B like boy, O, then continue with the word tea, and then the word club. The complete website is TeheeboTeaClub.com. Or call us at 818-610-8088, Monday through Saturday, 9 a.m. to 5 p.m. California time. That's 818-610-8088, TeheeboTeaClub.com.
It's time to make the Tri-City Center in Redlands a regular part of your weekly shopping experience. Tri-City is home to a wide assortment of quality businesses, including the all-new Ocean Aquatics. Check out their variety of exotic tropical fish, along with fish food, accessories, and tanks of all shapes and sizes. The Tri-City Center is located just off of Alabama and the Tennessee exits in Redlands. Visit the Tri-City Center today and find out why it's called the Mall with a Heart.
Poseidon Valley Tree Service reminds listeners that during these trying times, blood supply levels are critically low, making blood donations essential. Take the time to donate blood today. Visit redcross.org to find a location near you or call 1-800-RED-CROSS and schedule your donation today. This reminder courtesy of Poseidon Valley Tree Service, proudly serving the area with a full range of tree service for over 15 years. For tree trimming and service, mulch installation, and more, call 909-855-0264. That's 909-855-0264. Or visit TreeServiceLakeArrowhead.com. That's Poseidon Valley Tree Service, on the air because they care.
What would you do if you had a broken bone? You'd go to the doctor and use your insurance, right? Well, what would you do if you have a serious problem with drugs and alcohol? Most people do nothing until it's way too late. Your insurance can help you get clean and sober with the assistance of a place like the Detox and Treatment Helpline. Many times, addiction treatment is fully covered. So why not use your insurance to treat your addiction problem just like you would if you had a broken bone? And with the Family Medical Leave Act, you're allowed to take time off by law, and your employer doesn't need to know the reason. So there are two good reasons.